Ready to make the next big hotel deal? Join nearly 3,000 global leaders at the 25th Annual ALICE. As the world's leading and most influential hotel investment conference, ALICE takes place January 26 through 28, 2026 at the JW Marriott and Ritz-Carlton LA Live. With more than 40 powerhouse sessions and 150 industry visionaries on stage, this is where the future of hotel investment takes shape. Visit aliceconference.com for more information. Hello and welcome to another episode of Tell Me More, a hospitality data podcast. I'm Stephanie Ricca with CoStar News, as always, or usually, here with STR's Isaac Collazo and CoStar's Jan Freitag. Hi, guys.
Hey, good morning, Stephanie.
Good evening, Stephanie.
See, I would say good morning, but Jan is in Thailand. So, usually listeners, we are broadcasting to you from our cozy offices in Cleveland and Nashville. So we can say, Isaac and I can say good morning, but Jan is in Bangkok. So we're going to hear a little bit more later on in the episode about what he's doing there and some of the information he's picking up. But set the scene for us, Jan. What do you see outside your window?
Not a whole lot, honestly, because it is 13 hours ahead of you. So the sun has set. I'm from the future, and I can tell you it's going to be overcast. I'm here.
Uh-oh, is that a metaphor for global hospitality industry performance for the next 13?
Possibly. You have to stay tuned to find out.
And find out we will.
Quick shout out to the fine ladies and gentlemen from leading hotels of the world who flew me halfway around the world to present to them on a topic that we will talk about later in the episode.
And he's so committed to the podcast that we made him stay up late while we got up early to bring this to our listeners. And we, of course, cover news from around the world and back here in the USA. The big news since last we gathered, of course, is that the U.S. government is back open and running. Flight schedules, for the most part, are back to normal. That's very good news, which we'll talk about. We also have the latest U.S. hotel forecast revision from CoStar and Tourism Economics to talk about. Spoiler alert, it's a further downgrade, but that's not anything unexpected. So with that, let's get right into it. Isaac, I'm going to turn it to you to recap October for us. A lot going on.
There is so much going on. I have 5 pages of notes, dear listeners. But we're not going to go through every piece of notes. It's just, there's so much. Oh, yeah, I know. I figured you'd freak out, Jan, because it's so much notes. So, Jan, you won't be hearing from Jan today because we're taking the entire podcast. So, no, we're not going to do that. But what's really interesting is I think you're going to have to, if you go with me, and we'll be writing about this, obviously, in press stuff, but it was not as simple as what you saw in the numbers. What we do know, just to start off top line, RevPAR for the U.S. industry was down 0.9% in October. It was the 5th consecutive monthly decrease, but the lowest of them. Keep all this stuff in mind. And RevPAR has been flat to down since April. There was one day, I think May was 0.0, so we can't say it's been down every month since April because it was 0.0. That's why we say that. What's really interesting is occupancy was down 1.6 percentage points. It has fallen for 8 straight months. And this was the largest retreat so far. So now you're saying, oh my God, there was an impact from the U.S. government shutdown. But wait. There's more to come. ADR was down up 1.5%. It was the best increase of the past 6 months. But again, as you well know, dear listeners, that's well below the rate of inflation, which is about 2.9% this month. So it's still, while it's positive, we're still going arrears when it comes to margins. And I thought what was really interesting, when you look at ADR, it's averaged an increase of 0.5% since May. And that's the lowest growth average outside of a recession and obviously outside of the pandemic. So it's a very low growth that we're seeing in the industry. So government shutdown, we talked about, you just mentioned it, Stephanie, from October 1st to 13th of November. And it's easy by looking at the occupancy numbers for the month to say, oh my God, it really impacted us. And so what I started doing is unpacking it, looking at it multiple ways and by number of days. So in the 44 days of the U.S. government shutdown, total room nights were down 2.3 million. And before the 44 days prior, they were only down 1.6 million. Okay, further evidence. This really impacted the industry, right? So you have occupancies fallen by the most it has since this year began. And now you see a delta between pre and post shutdown. But there's a couple of things you have to keep in mind. First of all, TSA screenings during those 44 days were up 2%. Yes, they were up 2%.
Wow, I didn't
and folks
expect
are
that.
not talking about that. So people were traveling. Here's the deal. Last night I was at a dinner with one of our clients, and we were talking about it. That all of us that were traveling during that time period were, if you had to travel, you traveled, right? Or maybe transient did not, but most of us, for business, we were traveling. And so, yeah, it was an inconvenience, but you didn't stop traveling. Transient leisure might have. But the bigger issue, the reason why room nights were down versus the prior 44 days, hurricane markets. Everyone's forgotten that a year ago, and beginning in September of this year and now continuing October, we had a real impact from the hurricane markets. The hurricane markets, 13 markets, accounted for 57% of the total U.S. room decline in the month. And half of those nights came from the economy hotels. If you exclude the hurricane markets and now look at the data, RevPAR would have only been down 0.1%. So that's the impact.
That was a good pause for gravity, Isaac.
Yeah.
So, I mean, again, I think it's really interesting. And I looked at it multiple ways. And then, so now going back to the daily data, remember I said it was down 2.3 versus 1.4 pre and post, remember? Now, if you do that same thing, taking out the hurricane markets, and the 44 days of the government shutdown, room nights were only down 793,000 versus 1.2 million down prior to the shutdown. So I believe that the government shutdown had little to no impact on the U.S. industry. While you may hear about it and you're going to hear how people weren't traveling, there is no evidence to say that people did not travel. In fact, even the hotel data looks good. It was just a crazy group month. And again, even though
Which it needed to be, right?
Right. Even though we had the shutdown, people were traveling. And so I think, I keep going on. I have so much data here. That's why we're going to have to write about this, because again, there's just so much that happened this month that it's not as easy to say, oh, it was really a bad month. It really was actually a decent month, all things considered. Again, you had the hurricanes. You still have weakness in Vegas. You still have weakness in Houston. There's still areas that have weakness, but overall, it was a decent month. And there's even more, if you can believe that. New York's, again, had the nation's highest occupancy, 89.4%, for the month of October. That was the highest of the year for New York City. The other markets that saw their highest occupancy of the year included Austin, Boston, that's interesting, Austin, Boston, Los Angeles, Nashville, San Francisco, and 16 other markets in and out of the top 25 markets.
Do you think that group bump delivered some of that?
I would imagine it had to, especially at some of those cities. Yeah. So again, I think and again, we have so many notes. Overall, luxury hotels are still leading, as we know. Year to date, U.S. RevPAR is down 0.1% because, again, we're still looking at the total aggregate. We don't pull anything out. So there's still, it's still not a great month, but again, it wasn't as bad as I think people feared. And then outside the U.S., RevPAR is doing really well. Global RevPAR was up 5.2% on ADR growth of 4.9%. If you exclude the U.S., global RevPAR is up 7.9% on a 6.7% ADR gain with rising occupancy. Some of the leaders included Germany, the GCC, the Gulf Cooperative Council, India, and Japan, where RevPAR rose in the month by more than 12%. And then other countries doing really well was Australia and Canada. They were up by more than 9% in the month. And I was in Dubai earlier this month. And again, just seeing all those hotels and talking to those hoteliers, obviously that's part of the GCC. Amazing occupancies and ADR growth and continuing to grow. I was at some beautiful hotels over there. So overall, it was, again, I think a decent month. And I was talking, people didn't believe me at dinner last night. I'm going, no. I promise you. And I didn't check the data this morning because again, I'm like, well, maybe I'm wrong, but everything points that it was a decent month. So
listeners, now you have your dinner conversation starters for the weekend. Jan, were you surprised by that government shutdown info?
Yeah, absolutely. I'm so glad that Isaac did the heavy lifting and did the math and basically showed us this, that it was basically a flat month. If you adjust for certain outliers, the hurricane markets, I thought it was really, really interesting, to say, oh, actually it wasn't quite as bad as we thought. And then you mentioned group demand, right? So October 2018 was the last high. So clearly October is the big group month. This year was no exception, no matter what. And I also think that's super duper interesting in terms of just the psyche of the group traveler, that corporations are saying, no, we have to get out there. Or even if we only do this one event, it's the big event, it's in October, let's do that. Maybe we're cutting on the edges, right? And we're seeing that our room demand is not great, but people are traveling for this group event in October, and that's what TSA data showed, and that's what our data showed. So I think
that was the most surprising thing when data became available, because during the shutdown there was no data, and so literally the day after there was data, and it was like, what? There's data, and we quickly started looking through it, and I was surprised it was positive, and I think people still think that we're making these numbers up, but no, that was positive, and so I know we laugh because, and again, we're always very careful checking it multiple times, that we added all correctly and all that good stuff, but I checked it again this morning and it continues to show that it was up. There are some markets though that people are going to see and go, see, I told you it was impactful. Again, Houston, don't forget, Houston also had difficult comps, so don't look at Houston as a market, a barometer of the government shutdown, nor should you look at Miami or New Orleans, because something really big also happened last year in those two markets that really, really pushed ADR. And her name is Taylor Swift. And again, people forget, because you look at the market and go, why is it so down? And why did, ADR fall by double digits? Well, a lady's name is Taylor Swift.
Nobody forgets Taylor.
No one forgets. But again, it's funny that people are like, something's really wrong. No, it's just, there's a lot of comps. We've got to continue to look at the history, go backwards, check what happened in the market. But overall, to see Los Angeles getting their highest occupancy of the year, again, it's all relatively, like even San Francisco, but in San Francisco, just to be fair, it's still 13 points below their peak from 2019. So it's not like San Francisco is back to 100%, but it does show again that folks are traveling to San Francisco. Again, Dreamforce was there this month in October, and it shifted from September. So that's another added boost to the city and to the U.S. numbers.
That's good news, really, October, especially because I know when you all were talking about what you were anticipating for Q4, a lot hinged on October. And so when that shutdown hit, there was a little bit of worry there. Now, Jan, I want to ask you to unpack the latest forecast revision a little bit.
Right.
From CoStar and Tourism Economics. It's a downgrade, as expected. It's been doing that. What are some takeaways that we need to know about it?
So I would frame this as a progression of successive downgrades, right? We met at the Alice Hotel Investment Conference in LA, and Amanda Haidt, suggested, look, new government, tax cuts, 1.8% RevPAR growth. That sounds about right for the year. Not set the world on fire, not above CPI, but still, growth that we can live with. Then the tariff announcements come out, and the rhetoric around the 51st state and the rhetoric around visas. And so we suggested, well, maybe it's, 1% at the NYU conference. Then HTC comes around, we really see the impact of the uncertainty that the tariffs have caused. And we said, it's really flat, really minus 0.1% is probably how the year ends up. And we only have, a month and a half to go, but we are on a cadence. So we have to relook at our quarter, our forecast every quarter. And now we're saying minus 0.4%. So we went from plus 1.8 to minus 0.4. So that's an over 200 basis point swing in a forecast. People talk to Isaac and me all the time. That's like, how good is your forecast? Really, if you restate it all the time? I'm like, well, if the data changes, we have to do our job. What good is a forecast, right? If we today would still say 1.8%, we'd be laughed out of the room. We have to adjust it. It's just, unfortunately, a downward trajectory. Sorry, Isaac, and one other quick thing. So we are now saying Q2 was negative, Q3 was negative. We expect Q4 to show negative RevPAR growth. And our projection for Q1 of 2026 is actually flat to slightly negative, which gets you to one full year of RevPAR deceleration. So we're looking for catalysts, ladies and gentlemen. Email us, tweet at us. We'd love to hear what you think could go right, because right now we're just seeing, wow, it's flat to down.
And just keep in mind, again, as you're talking about, Jan, again, the hurricane markets, remember, I pull them out. And yes, underlying there's some better performance out there, but because we're looking at the total U.S., the forecast is for the total U.S. That don't underestimate. And again, the big impact from the hurricane markets is going to be the fourth quarter and first quarter. So therefore, that's why the forecast makes sense. I know a guy who works on those forecasts, and so that's why it makes sense. And again, going back to your commentary about why we changed the forecast, again, the shocks. Don't underestimate the shocks that the new policy changes brought about. And that's something that could not be picked up on any of the economic data, especially a year ago when before we went to Alice, that no one knew. People know that there's going to be an administrative change and there's always some kind of impact, but these were much larger impacts than we normally see with an administration change. So I think all that will be behind us. So yes, after we get past the first quarter, it may not be a catalyst per se, but at least some of the uncertainty and some of that shock value would have worn off. And then you have World Cup and you have other things that hopefully will propel the industry. Maybe not greatly where we see double-digit or even high single-digit RevPAR growth, but certainly, hopefully, not stay in the negative category.
Yeah,
and I think
just as an analyst, I hope that this connection between GDP growth and demand growth, eventually one day when we grow up, is going to come back together. Because GDP right now is growing at a fairly healthy clip, driven by all sorts of capital investments, and there's a whole podcast about that topic on its own. But the point is that GDP growth and demand growth have been disassociated, and they're not growing in lockstep anymore. And I'm long for the days when that happens again.
And also, I think, again, we're seeing such economic impact right now, especially because of the higher cost of living. I think that's part of the disconnect that we're seeing in that GDP number, because it's still growing, but folks are having to be very careful on what they spend their money on, and especially if you're in the middle to lower income. So I think that's causing disconnect. And then we also have alternatives that we just didn't have historically, which are impacting the demand side on hotels. Because again, if you look at the short-term rentals, they're still growing. So there's just a lot of, it's different. And maybe I'm not sure it ever come back exactly the way it was, because it's just different this time. And I know you're never supposed to say that, but I'm going to say it's different this time.
Yeah, I know.
Clearly that data is a living and breathing thing.
Yeah.
All right, we're going to move into our topic of the month this episode. And we talked in the last segment about the disconnect, I think, between some of the elements of industry performance, some of the classes. And it's no surprise that luxury and high-end hotels have been performing well and registering good numbers across the board. But this month, Isaac and Jan both are going to look a little bit deeper into ultra luxury. That's a segment above a segment. You talk about the 5-star, the 6-star. Is it really real? Does it exist? It does exist, as the data is going to show. So, Jan, start us off with some of the latest learnings that are coming in about this ultra luxury segment.
Yeah, thanks, Steph. So we talked about bifurcation in the industry all the time. Turns out there's bifurcation in the luxury sector as well. There is the luxury class performance, and then there is the ultra luxury class performance. Of course, the first question that our listeners have is, okay, what's ultra luxury? Like any good analyst, the first thing I did is I went to Copilot and asked, okay, so what is ultra luxury? And the answer is definition of ultra luxury: unparalleled service, exceptional privacy, opulent design, unique experiences, high price point, cutting edge technology, and sustainability. And I thought, okay, that.
I was going to say, essentially, it's your kind of place.
What can I say?
I was waiting for that joke. I'm glad I didn't make it.
I had to come off mute for that one. Sorry.
Isn't that the Oscar Wilde quote? I have a simple taste, only the best.
Exactly.
So what that definition is, it's very qualitative, right? It's kind of in the eye of the beholder, but Isaac and I were data guys, we're quantitative guys. We have to look at the ones and the zeros and say, okay, can we make this a little bit more black and white? And so for the analysis that I did is I took the 10 most expensive, the 10 highest ADR properties by market and grouped those together and looked at their ADR versus the luxury class ADR. And then I just sorted them by highest ADR around the world, ultra luxury ADR around the world. Let me rattle off some numbers just for context. So in Paris, an average luxury room costs just under $1,000. This is for the first 8 months of this year. But for the top 10 ADR properties, that ADR was $2,600, double what a luxury class ADR is. In London, average luxury ADR, $600, ultra luxury ADR, $1,600. New York City, average ADR, $470, call that $500. Ultra luxury, $1,500, and so forth down the line. You get the idea, right? There's $1,000 difference.
More than double. More than
double. There's $1,000 difference, in a lot of the markets around the world between what luxury hotels charge and what the ultra luxury, here defined as the 10 most expensive hotels, charge. Before we keep digging into this, quick disclaimer. Number one, this is not a data set that you can get out of the product. I basically ran a trend, which is, if you are a subscriber, you can do in the product. Number two is, this is what I proposed ultra luxury is. You can absolutely disagree with that and say, no, yeah, it should be these 12, or it should be these 8. You can make your own set. If you're a subscriber, you can pick. We cannot share the individual properties that are part of the top 10 highest because that would break confidentiality. We can't do that. But just know that this is, again, maybe a little bit in the eye of the beholder. I just took the easy way out and said, okay, show me the top 10 most expensive hotels. What's their ADR? Show me the luxury class ADR, and then compare the two. And that's how I did the analysis. One other thing I thought was fascinating. So you do all this math and you get these really high room rates and you're like, wow, that's, sort of mind-boggling, because $2,600 implies that on an average Wednesday or Saturday, the room rate is probably, $4,000. Now, it turns out that a lot of these properties have a lot of suites, and they sell a lot of suites, so they probably also sell rooms that are $10,000, to get to that $2,600 or $1,500 average. But then I looked at the occupancy. And this, I think, is super interesting and maybe a little bit counterintuitive, but then you dig into it and you realize, oh, that probably makes sense. So in Paris, luxury class occupancy this year was 70%. Ultra luxury was 55%. In Rome, luxury occupancy 64%, ultra luxury 53%. And so along down the line, that the ultra luxury occupancy is significantly below what the luxury occupancy is. And then you think about that, and I think what's going on here is that around the world in the hotels, we've always bemoaned the fact that we're buying occupancy by discounting, But for the ultra luxury, that doesn't seem to be the case. They seem to say, here's the rate, take it or leave it. The hotels are, in some instances, I would call this half empty, but I think that's part of the allure. Mm-hmm. ChatGPT said, hey, part of what's ultra luxury is exclusivity, And then when I talk to some of the operators, they're saying, yeah, we also have guests who just show up with like 6-hour notice or 8-hour notice with their entourage. We need to be able to accommodate them. And obviously, if you're running a lower occupancy, you can do that. So to wrap it up, ultra luxury ADRs, very, very strong. This is true around the world. Very high delta compared to luxury class, double or 2.5 times what the luxury class ADRs, and occupancy significantly below. Thank you.
Interesting.
It is amazing. Again, I think we've been talking about this for the last 2 or 3 weeks. That's a good thing, listeners, that Jan sits right next to me in his office so we can go back and forth and try to define this. So I picked up the same thing, Stephanie. So when Jan started thinking about this and preparing, I said, hey, I wonder what this does to the industry. So I'm only going to look at the U.S. And I took a little different tact from the top 10 that he did in each market. What I looked at, I just put a line in the sand and I said anything that's over $650 a night across the U.S., we're going to call ultra luxury. Simple as that, because luxury is like at $300. I forgot what the actual ADR is for luxury. I can't remember at the moment, but I think it's around $300 in the U.S. And so, first of all, just to give you an idea, we identified 300 with a $650 ADR over the 12 months ending September of 2025. So that's how, just give you the base. I wanted to make sure it was a full 12 months of data and just identify these hotels. That represents not even the 1%. That represents the 0.5% of all U.S. hotels. In the U.S., in October, we had 64,779 hotels. We're talking now 319 hotels versus 64,000. 0.5%. Give you an idea of what these hotels did. In October, ultra luxury, as I defined it, saw RevPAR growth of 9.1% on a 4.1% ADR gain.
Wow. The ADR just keeps on rising.
If we just take out these 319 hotels, they really don't belong with us. They're not like us. Let's just get them out of there. U.S. RevPAR in October, instead of being down 0.9%, would have been down 1.3%. So that's a 40 basis point shift from 319 hotels. And I think that's an amazing thing, just as you think about it.
And, it makes me wonder, and I'll just jump in here for a second, Jan, maybe you know this. What does it say when what we call luxury, not ultra luxury, just sort of keeps growing so much that you now have to create a new tier for it?
Yeah, and we talked about this internally, and we have talked about this, and we have clients in the ultra luxury space who keep asking us, can you make another class? Like we have mid-scale, upper mid-scale, upscale, upper upscale, luxury. We don't call it upper luxury, we call it ultra luxury.
But even brands will launch and say we're premium economy.
But the problem is that we don't have enough sample. As Isaac just said, it's 0.5% of all hotels. So what that means is that we can make this, and as I've just showed you, we can show this in New York and in LA, but we can't do it in Biloxi. Right. And we can't do it in other secondary, tertiary markets and in some top 25 markets. And as the watcher of the data, as the keeper of the data, we can't just cherry pick and say, oh, here is something that only works for some markets or for some hoteliers. We have to have something that covers the industry. So this is sort of an on-off exercise. I'm glad we're doing it. I think there's a lot of demand for that specific data set, but we're not going to productize this and put this out every month and every week.
Well, we derailed you for a second, Isaac, so...
Well, since this is live, as you well know, Stephanie, I was completely frozen, so I had no idea where you guys were on this conversation. So I'm not sure what you heard, but I'm glad you continued the conversation without me. The other thing I want to just talk about is the revenue generation side. So in October, only three of our traditional segments saw revenue growth. It was luxury, upper upscale. It was ultra luxury, and upper upscale. They generated these three classes, again, trying to call it ultra luxury class, but let's just call it that, generated about $312 million in the month. 25% of that $312 million growth came from the ultra luxury. Mm-hmm. And if you take it a little further, if you look at the luxury segment, 39% of the growth, of the revenue growth in luxury came from ultra luxury. So again, just the power of these hotels. And again, going back, it's 319 hotels. We're not talking 1,000 hotels. We're not talking 5,000. We're talking 319 hotels. And so it just underscores how important they are. For the year, these hotels are running a 9.5% RevPAR gain with a 6.3% ADR gain. So they're not only do they have high ADRs, but they continue to grow that ADR at a pretty good clip. Versus what we're seeing. Remember earlier when we talked about performance, we said ADR in the U.S. was only growing at 1.5%, well below the rate of inflation. Well, here, these hotels are well above the rate of inflation. And so it's just they're an amazing group. They accounted for 42% of the revenue growth in terms of revenue generation for the year to date. So overall, ultra luxury, and upper upscale have seen revenue growth of $1.9 billion this year to date, October year to date. Ultra luxury is 42% of that.
Wow.
And again, that includes Super Bowls, that includes everything. So yeah, we know that, and again, we had an inauguration, so you had some very high ADRs at the very beginning of the year. That's why that percentage is slightly higher than what we see in October. But it's fascinating. And I think there's a lot more work that can be done, but I just think it's just, given the size of this small segment, it's just amazing what it's doing.
And these are hotels that are underscoring or underpinning those super high ADRs with product to sustain it.
Right. And they're growing and they're adding hotels. I didn't notice that as well. I didn't put that in all my notes. But from a year ago, we've added more of those type of hotels. So they're still continuing to grow. And again, we just drew the line at 650 with an average ADR. So it's just, I think it's a fascinating. And a lot of those, what I did notice, a lot of those hotels, the largest majority of those hotels in the U.S. are in one city, New York City.
So you were looking at just U.S., right, Isaac?
Right.
Now, Jan, this week you're going to be around a lot of these hoteliers from around the world. So very interesting to catch up with you when you return on some of the trends that they're talking about.
Yeah, if our listeners want to have do a little bit more deeper dive into this, I published very briefly something about ultra luxury. There are a couple of charts in there that might be of interest. But the Wall Street Journal was kind enough. Kate King took the data, and we said, "Hey, if you publish this, we give you a quote, and you can have the data." And they were nice enough to publish it. I think 10 days ago or so. And the quote, I talked to her for quite a while, but the quote she gave me is that the customer want it when they want it and they're willing to pay for it. And that was a little bit flip. I'm not sure I meant to be that on the record, but I think it came out okay, because the point of that statement was that's what we see in the ultra luxury rates. They're willing to pay for it. And that's why Isaac is saying, there are investors and developers who are now putting more money into those types of properties and growing the ultra luxury stock, because that is, to be flip, the only place to hide, so to speak, in the U.S. hotel industry right now, because everything else is a little bit more dicey. But the upper end is doing quite well, and the upper end of the upper end is doing really well.
And you're hearing that from the airlines. Premium cabins are selling like never before, so it's not surprising per se. It just, this gives you the real data behind it. And again, as you said, Stephanie, how it really underpins the industry. And again, it's just a fascinating that it's only 319 hotels, and how much of an impact if they didn't exist.
And it gives you that data point, right? You talk about the qualitative versus the quantitative, looking at those ADRs over a sustained period of time, not just over an event week. Then you look at what underpins that. And even this week too, you mentioned we hear about airline cabin premiums selling out so much. Hilton Honors launched a new upper end tier of their loyalty program, which I imagine, you see loyalty programs changing a lot, and they are catering to their version of the upper end. So bifurcation is alive and well.
Very alive and well.
All right, gentlemen, as we bring this episode to a close, we will close the way we always do, in which you both share a fun metaphor about where the industry sits right now from your perspective. So, Isaac, we're going to start with you this time.
I had it's always about music. So I had two songs. The first, I was trying to figure out how to weave this in, but it's a song by a band called Gorillaz, The Happy Dictator. So we'll just put that out there. If you want to listen to it, it is a great song. It probably has political overtones, but the idea is that you'll sleep better because we take care of everything for you. So I like that, and it's a very poppy, it's very Gorillaz. It's very, it's a great song. But the real metaphor that I'm going to use, because I couldn't figure out how to make it all work with Happy Dictator, I picked a band called Yellow Card. They've been around for a while, and they have a song called Better Days. And I just thought, hey, there are better days coming along. And again, I started thinking about, sometimes we dig and dig to find those better days, but then you do see that there's, maybe green shoots, and we're going to talk about that here and there. It's not going to completely change. Things are still going to be tough. We all agree with that. Our forecast suggests that. But there are going to be better days, and it's just a matter of time, and things will change and get back to normal, hopefully by this time next year. So that's my song, Better Days.
See, there's a good forecast data point, right?
I like it.
Jan, what's yours?
Mine isn't quite as upbeat, maybe. So I left Nashville, Tennessee on Monday morning, and I landed in Bangkok on
That sounds like
Wednesday
the start
morning.
of a country song.
Exactly.
It's CMA Awards tonight.
Yes, exactly. Red carpet. So I missed a Tuesday. My Tuesday never was. I lost a day. And I think when we look back at the hotel industry in 2025, it was a lost year. You know, it went from could have been something to really not a whole lot there. So I think 2025 is a lost year, and my Tuesday is also gone.
I'm sorry you lost your Tuesday, but your name is Friday. You don't need
Your
a
name
Tuesday.
is Friday, so you carry that with you like a turtle shell. Hey, Fridays are the best days, right?
Yes.
Thank you.
Well, listeners, we will, of course, add Isaac's song to our Spotify playlist, and we will link to the articles that Jan mentioned in the article and in our show notes. And, you know, the year may be coming to a close, but hey, as we've talked about today, we live in a rolling 12-month world, right? And there is no end, always constant beginnings. We're always here keeping track of the data and the news. Hey, our podcast is now on YouTube. So thank you for listening. Find all the news about the global hotel industry that you need at CoStar.com/hotel news. Give these guys a follow on LinkedIn, and we will see you next episode. Thanks, guys. Safe travels, Jan.
Thank you, and good night.
Good night, Jan.
Good night. We have a whole day ahead of us.
Yes.
I'm Terence Baker, News Editor, Europe, Middle East and Africa, and I'm the host of The Upgrade, a CoStar News Hotels podcast for the EMEA region. In it, I discuss with special guests the pressures, challenges, joys and exhilaration that comes with managing, owning and developing hotels in our glorious multifaceted industry. Discovering the EMEA region from the scenic northern shores of Norway to a heights of Table Mountain in South Africa, and most likely some chat about birdwatching, distance running and the English Premiership. Join us wherever you find your podcasts, on Apple Podcasts, on Spotify and on other platforms.
This episode of Tell Me More, a hospitality data podcast, was recorded on November 19, 2025. The episode was edited by Sean McCracken. Find all hotel industry news at CoStar.com/hotel news. Thanks for listening.